Number 1. People say welcome aboard when you buy. You just bought shares? Welcome to the party. You're part of the ship and part of the crew. Other investors are celebrating and slinging rocket emojis at you. This is not normal. People do not congratulate strangers on the internet when they buy shares of Microsoft, and they certainly don't treat investing like a team sport. Go to the Prudential subreddit and tell them that you bought shares. See if you get rocket emojis and people welcoming you to the battle against the short sellers. But when you're in a cult stock, every other trader is going to give you internet hugs like you just joined the family. And the reason they do that is subconscious. They want the aura around the stock to be overwhelmingly positive so that more people are enticed to buy and the stock goes higher so they can sell. But when the hype stock starts dropping, and it will, that family dynamic starts getting ripped to shreds when someone in the family actually sells. Tell people you sold and you'll get hammered with accusations of spreading FUD, being a hedge fund puppet, or having paper hands and selling at the bottom. It literally feels like leaving a cult. Apple investors do not shame sellers. That only exists in cult stocks. Number 2, people say when moon and when Lambo after the stock has already mooned. When a stock is shooting higher, sometimes triple-digit percentages in a day, that's happening because a load of people are buying shares. The more the stock is up, the lower the IQ of the people buying the hype. Down here, you've got the pumpers and whales accumulating. Then in the middle, you've got the influencers and apes looking to get their cut. And here at the top, you've got the FOMO traders and noobs. This is the room temperature IQ crowd, and they're the ones who buy a stock that's already up 400% asking when moon. After the noobs and FOMOs are on board, there's no one left to buy. They're the exit liquidity, and once they're in, that's when the whales and pumpers start the dump phase. The stock will tank, and the influencers, FOMOs, and noobs, they'll start a 2-year bag holder cope cycle. Do not be the FOMO trader, and if you are, recognize the signs that the stock is done. Remember that you're more likely to buy here than here, and when the whales have dumped, you are here. Stop fighting. That brings us to the next sign. Number 3, the hedgies are hitting your stock with a short ladder attack. We've seen it time and time again. When a new meme stock sells higher, everyone says hedgies are fucked, short sellers are getting destroyed, blah blah blah. The stock is going parabolic, 200% in a day. Traders are circle jerking in the comments section on how smart they are. And next thing you know, 30% drop in 2 minutes. The whales dumped. You might get a dead cat bounce, but over time, traders will abandon the stock for greener pastures. The stock will continue to trend down because bag holders are selling. That's when the cope begins. Once you see hedge funds are doing a short ladder attack, it's done. The cult stock is cooked. The mythical short ladder attack is the first stage of the 2-year bag holder cope cycle. Bag holders convince themselves that the stock is not dropping because people are losing interest, but because there are unspecified hedge funds coordinating with each other to spoof selling pressure. In the short ladder attack, multiple dark entities will short shares back and forth to each other, taking small losses when they buy someone else's short shares in order to make it look like the investors are bailing out. This will entice organic selling pressure to tank the stock price, at which point the hedge funds can cover and go long at a cheap share price. Bag holders of a cult stock will try to spin this as a short hedge fund panicking, and that traders should double down to stick it to them and cause a short squeeze. The problem is, this kind of attack doesn't really even seem to exist. Google Trend Analysis will show you that the term only comes up when a cult stock is dumping. And even if you do believe that the short ladder attack exists, fighting this is like trying to punch a burglar in the knife. If hedge funds are attacking your stock using illegal manipulation tactics, you'll want to own a different stock. You as the retail investor with $5,000 is not going to defeat the multi-billion-dollar hedge fund with trading bots. If a hedge fund is attacking your stock, you can make money by shorting it too. Then cover later when the stock starts going up again. Trust me, you are not sticking it to anyone by losing money buying a meme stock that's already done its thing. Number 4, you think analysts are placing low price targets to tank the stock so they can buy lower. It happens every time a horrible stock gets dumped. Analysts from Barclays, Jefferies, Bear Stearns back from the dead, all of them pile on with low price targets and bearish DD to warn their people not to YOLO in. It's reasonable for the analyst to see a meme stock rising and cover it, because that will generate a lot of clicks and everyone will read their article. But if you think an analyst is placing a low price target on your stock so that the price drops and the analyst can buy at a lower price, you're experiencing what is called bias. I'd wager that almost nobody in a cult actually reads the bearish DD from an analyst, but immediately dismisses it as FUD. They'd say the analyst actually thinks the stock will go up, but rather than buy it and place a high price target, they spread FUD so they can buy cheaper. Oscar Health was trading for $14.31 when analyst David Windley from Jefferies lowered his price target from $9 to $8. He basically rehashed his bearish thesis to get fresh clicks on a trending stock. But to the Oscar bag holder who bought shares at $21, healthcare sector analyst David Windley actually believes the stock deserves a $40 price tag, but wants to buy at $8 instead of $14. In real life, analysts do not tank their own success rate to try to screw with your meme stock. If they think a stock should trade higher, they buy shares and slap a buy rating on it. If you think the analysts looking for fresh clicks are trying to spread FUD so they can buy your meme stock at a lower price, you're lying to yourself to rationalize why someone would be bearish on a stock you really want to moon so you can sell it. Number 5. Finfluencers are making up reasons to be bullish. I'd like to use an analogy here. If you've ever been to Paris or Naples, you've seen groups of about 4 to 5 Albanians standing in a circle around a game with cups and a ball. You're supposed to place a wager and then follow the ball under the cups, and if you pick up the right one, you win money. It sounds deceptively easy, almost too easy, and people are suspicious. So, the game master has his friends stand around playing, making it look super easy to win money. That way, when a tourist shows up and sees a guy win 50 euros, the tourist wants to win 50 euros too. So he plays, and then the magician makes the ball disappear and you lose money. The tourist only lost money because he saw someone else win. Now, traditionally, you buy shares of stocks because you think the company is good and will make profit for its shareholders. You've looked at the company and its stock, decided you want to own it, and you buy shares. That's the traditional investing method. That's not what happens with Colt stocks. You see someone screenshot 300% gains on out-of-the-money calls on a meme stock, and you become that tourist. You buy shares because you want to make money too. The stock may go up or down in the immediate term, but you are the exit liquidity for when the stock dumps. And when it does, it creates bag holders. And those bag holders need other people to keep buying shares so that they themselves can recoup their losses. This is when you start seeing Twitter accounts or Reddit users making up nonsensical reasons to be bullish. They seek to convince themselves that their investment is good and convince others to pump their bags back up. You as the bag holder need to be convinced that you bought shares because you like the company's fundamentals, even if that's patently false. And it is easy to make bag holders believe that they should buy more because they want to believe their underwater shares are a good investment. So you can really just feed them anything. Talk about forward price to sales ratios on a health insurance stock when you should be using the combined ratio of medical loss and expense ratios. Use earnings per share when talking about a real estate investment trust, even though the relevant metric would be funds from operations. Talk about how diluting shares is good for existing shareholders. The DD doesn't even need to hold up against the slightest bit of scrutiny. It just needs to sound good to FOMO traders who don't know the difference between free cash flow and EBITDA. Just tell people they're making a good investment and they should buy more. They're not going to ask questions. If you are a bag holder, reflect on this. You didn't buy shares because you did DD and decided the stock was good. You bought shares because you thought the stock would go up due to other people buying it. And now that you're underwater, you're going back to convince yourself the shares are still a good investment. You are feeding your bias. Instead, recognize this bias in yourself and take it from the top. Are you buying more shares because you actually think the company is good, or because you really want the stock price to go up so you can get your losses back? Number 6. A stock started gaining traction on WallStreetBets, and now its own subreddit has all the discussion. WallStreetBets is all about whipping it out and swinging for the fences. Refreshingly, that usually doesn't mean pump and dumps, but rather a real conviction about a certain stock, or just straight up luck. But occasionally, however rare, a pump and dump will indeed cross our tape and make our subreddit its home. People jump in, the stock sells, and then the hype dies. As I say this in late July, the dork stocks, Krispy Kreme Donut, Open Door, Rocket Lab, and Kohl's are the hot ones. In my opinion, Rocket Lab shouldn't be included since it's actually got some decent prospects, but that's beside the point. In time, the dork stocks will die. Krispy Kreme is losing money. Open Door is headed to bankruptcy. Kohl's sales are cratering. This pump will make many bag holders, and WallStreetBets will become bored of their copish DD, and those tickers will no longer be welcome. When your stock gets kicked off WallStreetBets and has to retreat to its own subreddit, it's over. We saw this with Faraday Future, ticker FFIE, now FFAI. The stock started getting pumped on WallStreetBets, got kicked off, and had to retreat to its own sub. An even better example is Bed Bath & Beyond. To this day, even though the company went bankrupt and the original shares barely even exist, Bed Bath has a handful of subreddits still trying to rationalize what's happening. AMC, same thing. After years of failure and dilution, the stock continues to create more bag holders huddling in their Cope Dungeon subreddits. Once a stock has suffered that fate, the only ones buying are institutions rebalancing their positions and cult members buying and selling stocks with each other. Unless something fundamentally changes about the company, like a buyout or a long-term turnaround, the stock will never get its hype multiples again. Look at AMC and tell me if it's worth holding. Once your stock is relegated to the corners, it's a cult stock. And number 7, reasonable bearish DD gets buried. The truth about these hype stocks is that the only reason they can move in price so fast is that they were cheap to begin with and had low trading volume. Once buying pressure comes in, they shoot higher quickly because buyers grossly overwhelm sellers. These types of stocks are generally not rising because there is some new bullish thesis. They're rising because people want to buy them, thinking the price will go higher so they can sell them to other speculators. Since there's really nothing new or bullish about the stock, the fundamentals are still bearish. Opendoor is still burning through cash flow, and its overpayments for houses during the 2021 bubble are becoming a burden. AMC is still diluting its shares because it can't afford to pay its debts otherwise. It is totally reasonable for people to present bearish DD. Both analysts and run-of-the-mill traders will talk about how these may be some of the worst stocks on the market right now. This will be backed up with facts about things like cash burn, debt-to-equity ratios, and a declining price to earnings. Even in regular stocks like Apple, bearish DD isn't usually lauded among investors. But in a cult stock, the dog pile of hate will reach a whole new level. If you don't want to be called a paper-handed bitch, don't post bearish DD on a cult stock. Your post will be downvoted, and your message will not be further received. But you will not receive criticism on your thesis. No one will make counterpoints to discredit your arguments. Instead, you'll get roasted just for being bearish in the first place. If you're in an environment where bearish DD isn't criticized on its merits, but rather criticized by virtue of being bearish, then you're in a cult stock. Go ahead and stay long as you want to. Just be ready for that stock to tank, because it's coming, and then other bag holders will try to sucker you into buying more. Don't fall for it. This video may sound condescending, but we've all been there. I have made money with puts on cult stocks like Oscar and Open, and I've bag held others until I couldn't take the pain anymore. I've been on both sides of this internal fight. My trading improved when I realized the signs of being a cult stock investor. When it comes to cults, the only ones who win are the ones who get out. When you're trading on FOMO, a long-term investment is just a short-term investment that failed. Do not be the long-term bag holder. Remember, there is always another side to the cult stock investing. You can buy puts or sell call credit spreads. You can make money when a cult stock goes down, and there's nothing wrong with that. Come hang out in our free Discord, where we make more money selling options and running side hustles than basically any meme stock trader. I hope this video has been helpful. Let me know in the comments what cults you're still in, and I'll see you next time.